The operating profit margin is a key financial ratio that measures a company's profitability by assessing the proportion of revenue that remains after covering operating expenses, but before accounting for interest and taxes. This ratio provides insight into how efficiently a company is managing its core business operations, excluding factors like financing and tax strategies. Compared to other profitability ratios, such as net profit margin, the operating profit margin focuses solely on operating income, offering a clearer picture of a company's operational efficiency without the impact of external financial and tax considerations. Operating profit margin. The operating profit margin is calculated by dividing the operating profit, also known as operating income, by the total revenue and then multiplying the result by 100 to express it as a percentage. Operating profit is the amount earned from core business operations before interest and taxes are deducted. To calculate this ratio, first, determine the operating profit by subtracting the cost of goods sold and operating expenses, such as wages and rent, from the total revenue. Then, divide this operating profit by the total revenue. The result is multiplied by 100 to obtain the operating profit margin percentage. Example. Let's consider a company, XYZ Corporation, that has total revenue of $1 million. The company's operating expenses, including the cost of goods sold and operating costs, total $700,000. To find the operating profit, subtract the operating expenses from the total revenue. $1 million minus $700,000 equals $300,000. Next, divide this operating profit by the total revenue. $300,000 divided by $1 million equals 0.30. Multiply this result by 100 to convert it into a percentage, resulting in an operating profit margin of 30%. This means XYZ Corporation retains 30% of its revenue as operating profit. Low operating profit margin. A low operating profit margin indicates that a company is struggling to control its operating expenses relative to its revenue. This could be due to high costs, inefficient operations, or pricing pressures. A low margin may signal that the company has lower profitability from its core business activities, which could affect its overall financial health and competitive position. High operating profit margin. A high operating profit margin suggests that a company is effectively managing its operating costs and generating substantial profit from its core activities. This generally reflects strong operational efficiency, effective cost management, and potentially higher pricing power. Companies with high margins are often better positioned to withstand economic downturns and invest in growth opportunities. How can companies optimize operating profit margin? Improve cost management. Companies can optimize their operating profit margin by streamlining operations and reducing costs. This might involve renegotiating supplier contracts, improving production processes, or eliminating unnecessary expenses. Increase revenue. Enhancing sales through strategic pricing, expanding into new markets, or increasing market share can boost total revenue without necessarily increasing operating costs proportionally. Enhance operational efficiency. Implementing technology solutions and optimizing workflows can improve productivity and reduce operational inefficiencies, thereby increasing the operating profit margin. Key takeaways. The operating profit margin provides a clear view of a company's profitability from core operations, excluding interest and taxes. It is a crucial indicator of operational efficiency and cost management. A high operating profit margin signifies strong efficiency and profitability from core business activities. A low operating profit margin may indicate challenges in managing operating costs or pricing pressures. Companies can enhance this ratio by improving cost management, increasing revenue, and enhancing operational efficiency.